Excellent. Well, it looks like a pretty full house today, so we're going to get started. Thank you all for joining us here at our March special webinar, The Power of Retention Credits, with our guest, Ryan Foley. Ryan is a partner at Cunningham and Associates. I'm going to let him self-introduce, speak to his own background in just a minute here. I'm Dave Clayman, for those of you who may not know me, co-founder and CEO of 12 Points Wealth Management, and I'm joined as well by my partner, Francesca Federico, co-founder and president of 12 Points.
Hello, everyone. So we've got a lot going on here with the CARES Act, and as many of you know, as advisors, we're always trying to bring good ideas to our clients and other businesses, and we've been working with Ryan on a lot of these retention tax credits, and we do think that many of you on the phone could potentially qualify, and wanted to give you a little bit more information about what it is that we've been doing. So without further ado, Ryan, I'm going to kick it right over to you, and we can go through these retention tax.
Awesome. Thank you, Dave, Francesca. Pleasure to be here speaking with everyone today. And, certainly a very hot topic in the tax space. And it's really a universal incentive under the employee retention tax credits. It's been largely enhanced over the last few months, including the last two stimulus bills. Just a little bit about our firm, Cunningham and Associates. We've been around for 30 years. We're based out of central Massachusetts in Worcester. In terms of our firm, a lot of different highly credentialed individuals, but we focus in on the specialty tax space. And when I talk about specialty tax, it's a little different than what your normal CPA would focus on. We generally get involved in taxation when it gets more into an organization's activities, more the qualitative components, which is really a big part of the employee retention tax credits. Yes, there are some financial indicators for qualification, but large portion of our client base are qualifying under disruption clauses, and we're going to get into that today. So first is going in a little bit to the landscape. And just so everyone knows, we are pulling an audible on the slides today. So Dave is my fearless navigator. My internet is not as strong as his. So you may hear a couple next slides from us, so bear with us. So more stimulus. In December of 2020, Congress passed a Consolidated Appropriations Act that funded PPP2. It also created some enhancements to the employee retention tax credit. And under the American Rescue Plan, which is the $1.9 trillion bill passed into Congress, signed into law by Biden recently, it also expanded the incentives. And I'll go through and give you a little timeline on each one of those. As Francesca mentioned, the employee retention tax credits originally passed under the CARES Act, which was primarily the focus was PPP1 funding. But there were some provisions in the bill that did not allow a retention tax credit claim if an organization was seeking PPP1 forgiveness. So it was largely useless to clients. Most companies receive PPP, so it wasn't something that was utilized by many at all. Under the Consolidated Appropriations Act, they now reverse some of that language to allow a dual claim of both PPP forgiveness and retention credits for 2020, and they expanded the incentive into both Q1 and Q2 of 2021. Additionally, under the most recent stimulus, the $1.9 trillion bill, they expanded it further into Q3 and 4. So as we're going through this, a good way to level set our mindset is there are 5 separate periods. 1, 2020, the year, and then the 4 quarters of 2021. And there's different qualifying measures for each. And actually, Dave, would you mind just hopping back to that back slide for one moment? We're going to talk a little bit just from a PPP. This isn't a presentation on PPP, but it's important because looking at PPP, you cannot claim the same dollars for retention credit on the dollars that you're using for PPP forgiveness. So first and foremost, if you haven't filed your forgiveness app, hold off. It gives the most flexibility. If you have filed your forgiveness app, fear not, it's not lost. A lot of organizations, they filed the forgiveness app. They just used a very wide range of payroll. Said, look, we have 3x, 2x, 4x payroll versus the loan. Plenty of bandwidth for forgiveness. Under recent guidance from the IRS, it came out about 2 weeks ago, they have identified that if you have excess payroll in your PPP forgiveness app, you can allocate toward that payroll towards retention. So really, the bottom line is coordination is critical with the PPP loans. Both one, which is retroactive 2020, and also if you receive the second draw, it's even more important if you qualify under the first quarter. And I'll highlight some of those things as we go along. All right, so let's just go through some of the basic, the value of these credits. So there, as I mentioned, there's 5 separate periods. The most significant changes are going to be the rule change between 2020 and all 4 quarters of 21. So for 2020, organizations are eligible for up to $5,000 in credits per employee. The way that's calculated is it's 50% of the payroll paid during a qualified period. So it's scalable. So if you had an employee that only made $5,000, the credit would be $2,500. And again, depending on the periods that you qualify, would depend on whether or not an individual meets that $10,000 wage limit. Now, you'll notice at the top, I have 100 FT quote unquote E. Now, there's a fairly significant misunderstanding of FTEs, primarily because the term has been used under under PPP, where it's full-time equivalents. That's written in the bill under PPP, equivalent. Under the retention tax credit bill, it's not. The word equivalent is not used. It's full-time employees. So the calculations actually vary. So you may think I have 100 or 120 full-time equivalents because you take your part-timers and you aggregated and created an equivalent full-timer. Under retention, you may actually have only 60 full-time employees. And the definition of a full-time is 30 hours or more per work week. And the calculation you need to go through each month of 19, divide by 12. But you can essentially, under the right circumstances, eliminate a lot of your part-timers from your calculation, helping employees drive under that 100 threshold. Now, why is that even important? That 100, and you'll notice in 2021, the 500, those numbers are important because if you're under that threshold, you can apply the credit to your entire employee base. If you're over that threshold, the credit application becomes much more limited. You can only apply it to individuals you paid not to work. So it's a it's a far smaller pool versus if you're under 100, it's the entire employee base. Now, fortunately for 2021, they expanded that significantly. So they raised that bar. It's now 500. You're going to find a lot more organizations are going to qualify in 2021 versus 2020. So that's the 100 and 100 marks. We're looking very closely at that. If you have a high amount of part-timers, you should be thinking, okay, I got to look at full-timers in the calculation. You might just be overlooking some things. So the credit up to 5,000 in 2020. For 2021, it's up to 7,000. So they increased the percentage. It's now 70% versus 50, and it's every quarter. So I know the title of this webinar is Save 19,000. Well, in the blink of an eye, by the time we set this out, 2 weeks later, Congress passes a new bill. Now it's 33,000. So what happened is it just got better. It just got better. I'll also note, you'll see a little star in 3 and 4. There are some unique provisions I'm not going to cover today for organizations that were heavily impacted. If you're a startup, if you started your business in 2020, or in the 3rd and 4th quarter, if your revenue is down 90% or more, that's significant, 90% or more, you can actually qualify for even more than the 33. But for today, those are special provisions. Reach out to me if you fall into those conditions. We can talk it through. All right, next slide. Let's talk about qualifying measures. 2 main qualifying measures: a revenue decline versus a normalized year. Now, normalized for the sake of these credits is 2019. So when we talk about comparatives, it's going to be the base comparative quarter or year versus 19. Second, if your business operations are suspended in any way by a government-ordered shutdown. This is easily one of the most misunderstood components. Many organizations think they don't hit that revenue threshold and they don't qualify, when in fact, there's been even more support on what the partial or full shutdown means, it doesn't mean that you weren't profitable. Further, and I'm going to touch on this again, but I'm going to hit it twice. Revenue, revenue doesn't even come into play. Your business can be impacted and you can be more profitable, which I understand, it's a little crazy to think about it, but that's the fact and that's the way the bill's written. So let's hop into revenue first, which is certainly the most bright line, straight test. 2020, extreme revenue drop required. In a single quarter, you need to see a 50% or more reduction in revenue versus that same quarter in 19. So most organizations that are meeting this threshold, it's in the second quarter. That's when most of the shutdowns happened. That's where many organizations experienced extreme loss. But 50% is extreme. Now I can say only about 15% of our 2020 claims actually fall into that category. Okay, so if you meet that category at 50%, the nice thing about it is you have a lot of bandwidth, a lot of runway in 2020. So you're going to receive the qualifying quarter that you have 50%, and it actually extends to every quarter after that until you have a 20% or less revenue drop. So you need to have your revenue normalize out, and then that quarter would be the quarter that it ends for the claim. So there's a little bit of a domino effect when it comes to that 50% revenue drop. So there are obviously some benefits to a really bad situation here. 2021, they lowered that bar substantially, 20% reduction in revenue in 2021 versus 19. Now, there's two ways you can look at it. One, you can look at it as the quarter that you're trying to qualify. So let's use this quarter, the first quarter of 21. If the first quarter of 21 is 20% or more revenue reduction versus Q1 19, you qualify for this quarter. So that's one way you can qualify for this quarter. The second way that you can qualify this quarter is using your preceding quarter. So if Q4 20 is 20% down versus Q4 19, you automatically qualify for Q1. That's safe harbor. Now, that same concept goes for the entire 2021 tax year. So, for example, you qualify, if you're 20% or down more in this quarter, you're going to automatically qualify for next quarter. You can have the greatest second quarter in your company's existence. It doesn't matter, because you meet safe harbor. Now you're going to qualify for next quarter. So that's important to understand. We have many business owners that are like, I need to wait to the end of the quarter. Well, how was last quarter? If it's down 20% or more versus 19, you're likely going to qualify. Remember, the second mistake that we often hear is comparing to 20. 19 is the comparative year. You always want to go back to 19, the same quarter. So that's revenue. Let's talk a little bit more about business disruption. I said I was going to talk about it twice. Income is not a factor when it comes to the business disruption. However, it can be a leading indicator. So, for example, we have organizations in second quarter last year, they were down 30%. Well, what happened, right? That's a good leading indicator that something happened to impact their business to that magnitude, right? So now, often with the business disruption, it's considered that my business was shut down, or I was essential or not. None of that really matters. Okay, obviously if you're shut down, it's qualifying, but if you're essential or not essential, again, that's not in the code at all. Okay, so if you look at some different elements, certainly a full shutdown will qualify. A work from home order. So if your organization traditionally didn't work from home regularly, and then you had to move your whole office from a physical work environment to a virtual work environment, that potentially could qualify. Think construction here with job site shutdowns or service-based industries. If you could not go to the place you would normally perform work because of a government order, then you would qualify. I use a lot of my construction clients. They did very well last year after the initial shutdown. The second quarter was awful, but after that, it flew off, right? They had the work in progress, it just went. If you look at Boston, the whole city was shut down. All construction sites were shut down for a period of time. Now, what generally construction companies did, they started working on other job sites, maybe in New Hampshire or wherever they were, but Boston was shut down. That is a qualifying measure. Now, it's only for the qualified period of the shutdown. So generally speaking, essential businesses that had some shutdowns, we're looking at phase one, begin middle of March to June. That's a really hot period that we find a lot of qualifying weeks in there. And when I say weeks, 4 to 6 weeks of disruption, that usually will generate a significant credit for an organization. Capacity restrictions, think restaurants, think health clubs, big one. Supply chain disruption. This is unique. If part of your supply chain was disrupted due to government mandates, we have a client that manufactures vehicles, and they couldn't get frames from Ford, chassis, couldn't get them, shut down, Michigan. So what ended up happening is that organization qualified because of that supply chain disruption. Yes, if they could manufacture, their customer would buy, but they couldn't get the components they needed. Commerce, and this is pretty general, so this really comes down to the case by case. Was your commerce disrupted? If you are an organization that services restaurant groups and then the restaurants are shut down, that impacts your commerce. Yes, you are able to perform service, you have the people, but your customer base, you can no longer have the commerce that would be normal. And the leading indicator or the leading factor is the government mandates. Then travel restrictions, again, case by case. Recent guidance on a partial disruption. I just want to highlight this because frankly, as a firm, we interpret and then we apply the tax code. This new guidance was a lower bar than we anticipated. Partial shutdown defined by the recent guidance put out by the IRS is that it's a 10%. So it needs to be more than nominal. To pass the nominal threshold, it's 10%. 10% by revenue stream or 10% by hours. So if your people are doing things differently, and we're not able to do 10% of our normal hours, or if we had, say we're a janitorial company and we service schools and restaurants, but we had a whole other slew of things that we're able to do due to sanitation requirements, but that school and those restaurants were in a normal year, 10% of revenue or more, that could meet the nominal threshold, and then you can qualify backwards. So this is qualitative. This is where it gets a little bit more complex. I don't want to use the word subjective because a lot of this is very clear, but it certainly requires an in-depth look at the conditions of the business, and you have to tie in directly to the government mandate. All right, that's probably one of the more significant slides we're going to go through in terms of where things are coming. So I'm sure we might have some questions regarding that. Let's talk a little bit about monetization. So when I hear tax credits, there's a couple different versions. You can have corporate level tax credits, things like that. This is a 941 payroll fully refundable tax credit, which means you can convert it to cash regardless of profitability. Okay, so there's 3 ways that you can receive the money. One is through an amendment. 2020 at this point, it would be an amendment. Then you can also file on original filing. If you haven't considered this credit yet, this is a perfect time to do it because we have Q1 ending in the next couple of weeks. So you can file your Q1 claim under the original return, and it's electronic filing. So you can, and then you can either apply it to next quarter's federal tax payments and have a credit weekly cash flow, or you can receive a refund from the IRS. So it's interesting, the concept is pretty simple. It's fully refundable through 941s, but the application of how to quickly get it and the best methodology behind it, that's something that's really client to client. All right. So let's hop into some case claim best practices. Okay, so this is really, this slide is to just talk about what our firm is recommending from a best practice perspective. Okay, so what you're going to find, and you'll see this in the case studies, is these credit dollar numbers are going to add up pretty quickly. What we're advising organizations to do is really make sure that your paperwork and supporting documentation is in line. Now, one thing I want to be clear, this is a claim, not an application. Okay, so we're not applying, we're not asking, we're telling, we're claiming. Okay, so what for our perspective on tax credits is document your claim, make sure that the methodology is very sound. So pull together a narrative, itemize the specific qualifying measures of why your business qualifies. Create management supporting documentation. This is critical if you're filing PVP forgiveness, because what you want to be able to do is take your whole payroll for the periods that you have both retention and PVP and separate them into separate buckets and prove out that you have enough payroll or, and I'll get into this, other qualifying costs to cover your forgiveness. You do not want to jeopardize your forgiveness. So well document that. Then go ahead and take a look at, especially for if you haven't filed for forgiveness yet on PPP1, and certainly you haven't done it for 2 yet, it just came out, you want to be able to look at other costs. pull money out of the payroll bucket and put it into the other cost bucket. Think rent, utilities, they've expanded it, now the utilization. You want to be able to take that 40% and put it into other costs if possible, so that you can free up more payroll dollars for retention credits. That's key. And if you think about it, if you have $100,000 worth of payroll, you're now be able to put in the retention credit bucket. You now have $70,000 more in your pocket versus the forgiveness, right? But you still receive full forgiveness. So it's essentially another found $70,000 under that scenario. The 941s, reducing, again, you want to document that well. Payroll companies, I've spoken to many of them, large and small, and generally speaking, payroll companies are in the business of gathering data, providing HR support, compliance. They can process a lot of this, but from the advisory perspective and really the strategy, that's really where you want to talk to your advisors and get really honed in on the different elements. Because you can, when we talk about a double dip, PVP is one item, but I was guest speaking in a webinar recently. It just had a very small portion of regarding funding different stimulus packages. Under the most recent stimulus bill, there's a new restaurant grant that came out for up to $5 million a location, $10 million, right? That you can't double dip with the retention credit. So there were, just on the back of a napkin, I counted 6 to 8 different incentives in Massachusetts alone that you need to be able to sort out and put into buckets so you don't double claim. Think Mass Growth Capital, they gave out $75,000 grants. There's all sorts of these other stimulus packages that you may have received. So you got to balance all of that and make sure that everything is buttoned up tight. So let's get into case studies. This is the most fun part. I try to get through the beginning quickly and talk about real cases. So the number, it's about a week old. It's increasing daily, but about $30 million in documented claims out of our office. We signed up our first engagement on this about 10 days after the bill passed. And so you're looking at January 4th, January 5th, and since then there's been about 30 million in claims, so significant. So running through some cases here. So this is a construction subcontractor. Great example of an essential contractor. They had some jobs halted and some job sites limited. This is a contractor that was doing well, actually was reasonably profitable in the second quarter, had other job sites that they could go to. However, some of the major jobs that they had going on, they could not go to because of job site shutdowns. So we qualified them. It was about a 5-week period that they qualified for, and that was it. 5 weeks in 2020 and nothing in 21 because they didn't meet any of the other qualifying measures. This particular client is receiving about $250,000 in retroactive credits. All right, hopping into a restaurant group. Now, restaurants, there have only been a couple that I've engaged that haven't met the revenue decline. So, you know, the vast majority of restaurant groups are meeting that 50% gross receipt reduction. The capacity limitations were up until recently very significant. But the main thing with this particular group is we're able to go back and retroactively claim for all of 2020 because of the restrictions and other generally the gross receipts decline for restaurant groups. So this is a small restaurant, 22 employees. They received 85,000 in retroactive credits and 140 for Q1. We need to look at Q2 to see if they're going to qualify. It's actually, they're doing okay, which is very positive. But right now, I mean, you're talking a very small group that received well over $200,000 in cash.
Oops. Shoot.
We do have some questions here, Dave, too. So
I was going to take them at the end.
Cool. Nursing home. So this is a nursing home elder care group. So this is actually, this particular group has 2 sites. So when you looked at them, their full-time employee counts looked high. Their employee numbers are very high, but they had a lot of part-timers. Now, why is that important? It's important because when you look at the number of 170, you think over 100, they're not going to qualify for 2020. Their FTE, the full-time equivalent number, was over 100. It was over 100. However, when you recalculate out the full-time employees, they were at 60. So that was important because we qualified them for retention credits. So this is a common misunderstanding. And because we dove deeper into this and looked at it, it's another $510,000 in credit that they're going to receive because of that, misunderstanding or misinterpretation of that particular rule. Now, this is something that we're seeing has been, again, come to light in the last 45 days, and it's been supported. It's one of those really the nuances in the rule that's important, and that's really indicative of that. Then again, in Q1, they continue to have restrictions. They had capacity issues, staffing issues. Due to they had a number of compliance checks and overstaffed. There were a lot of regulations on nursing homes because of the COVID impact in those specific groups. Received another $875,000 in Q1 21, which is received as an advance credit. One of the things about nursing homes too that we're seeing is their revenue. Some are up, some are down, but they may not meet that threshold. But net income is down because of the amount of staffing that they needed to bring on to meet all the government compliance. So, drawing narratives around that has been very beneficial for these organizations. Health club. We have so many health clubs that we're working with, both from a private and nonprofit perspective. Shutdown mandates, limited reopenings. This is, if I was going to identify like two groups as restaurants and health clubs, where that full-time employee numbers are critical because there's so many part-timers associated with these organizations. This is one of them. This particular group, 256 employees, 90 full-time employees, which is actually fairly high. 420 retroactive, and then we already are able to project Q2. So it's 375, and then another 450 we're looking at for Q2. They have a summer program, so they're going to ramp up a little bit, which is coming into play with a lot of these organizations that have kind of multiple activities that they offer. In the timing of when the scale up is coming on is being brought up a lot in our consultations, because many organizations that we're considering hiring, in say the end of June or early July, we're saying, well, if you bring them on in early June, you actually start getting retention credits on them like immediately, and you get 70 cents in the dollar. Like, oh, we can put those people to work. So they started looking at it from more of a strategy perspective, because every quarter that 7,000 resets for those employees. So they're getting a good discount on the labor, which is making them more competitive, and they're going to offer some different things, get the camp set up, do some repairs, all sorts of things. All right, moving along. Manufacturer, very similar to the construction organization. Supply chain disruption. They had some social distancing requirements, made them less efficient. They had to spread into 2 shifts, which was not typical for them, just to comply with the government mandates. And a lot of their administrative staff, which was deemed non-essential, were working from home, which wasn't traditional. So 450,000 for this particular case. And the last one. So this is a nonprofit. One of the challenges with nonprofits is many of them did not experience the revenue decline. And the reason being is that they still had their grants or their donations, or there's some rules. Again, from a revenue perspective, we talked to CPAs to find out what they're recognizing, but there's some investment income or other things that may qualify as revenue. So, depending on the organization, many of them did not meet the revenue decline. Certainly, if it's a nonprofit health club, it's a different story. But this particular group was deemed non-essential. They had 350 employees. They did not qualify for PPP2 because they have over 300 headcount. So this retention credit for Q1 and 2 was a lifeline for them. Lifeline. They're going to get about $3 million in retention credits because of their high employee counts, and it's making up for the fact that they're not receiving the retention credits. So there is that magic area where if you're over the 300 headcount and under the 500 full-time employee number, that's a great space to be able to get some additional incentives, even though you didn't qualify for PPP2. And then with this particular organization, you see the retroactive number there. It was actually, they qualified 2 ways. One is their actual full-time employees are less than 100, but the second is they actually paid people for 6 weeks when the original PPP came out to not work. They were closed and they paid them to not work. and they did not file their application. So we were able to put the PPP allocation towards the end and use that 6 weeks as paying people not to work. Now, fortunately, they were over 100, under 100 anyways. It didn't matter. But if they weren't, that was the backup plan. They would have still received probably 400,000 or 500,000. So, just if you fell into that category, it's still significant. All right.
Excellent. All right. Well, as I mentioned in the chat, you can feel free to fire some questions off in the typing if you have that capability, and I'll ask them. I think I'll go with the easiest one first. So, Ryan, a common misconception, I think you helped us with it a minute ago, but a lot of nonprofits think they can't benefit from the program since they don't pay taxes.
Yes. So it is common misconception. It's really how it's monetized. So it's monetized through a 941 payroll tax credit. So private schools, the other nonprofits, other charitable organizations, if you're paying payroll and you're not a government agency or a municipality, right, that you're going to be qualified.
Great. I have another one here for a museum that is reduced to less than full capacity by government order. Would they qualify for partial shutdown until they are back to full capacity, i.e. all of 2020, until they can go back to full capacity in 21?
Really strong case there. I'd be curious. So it's a museum. I'm assuming they're not going to meet the revenue thresholds. The capacity restrictions is a solid foundation for a claim. I will say that it needs to be looked at. We want to have a discussion about it because we want to insulate it beyond just capacity. You can't say that I had capacity, so I automatically qualify. It's not automatic, but you're 85% of the way there. We want to also just add some additional impact to that, to round out that 15% at the end. And every organization is a little different. Same with like a retail organization, where retail, you might have a capacity issue, but that doesn't automatically qualify. You need to be able to quantify the impact in some fashion.
Okay. We're getting a little more specific here. Hello, I've already filed for ERC for 2020. Can I still apply for the restaurant revitalization grant in 2021?
Yes.
Okay, excellent. We have, our Main Street grants treated like PPP funds?
Good question. So similar. If you think about it this way, if it's a grant, then it needs to be considered when you're applying for your retention credits. If it's a Main Street loan, that's different. So a loan is different. So you want to take a look at the different incentives, the different stimuli, and ultimately determine which ones you can use or which ones you can exclude and which ones you need to allocate. Now, one of the key things about a lot of these grant programs, and the restaurant one is a great example, you can use it for other costs. But you need to allocate. You don't need to, I use a phrase, you mark the dollars with the red X. You don't need to do that, right? So if you have a grant and you have all sorts of other costs, do that first. And you want to preserve payroll dollars. So an analysis would be justified there. But yes, you can certainly receive. It's just a matter of balancing.
And maybe, Ryan, I know we don't have this one up here, but my friends that you were able to help out, they were told by their bookkeeper that they weren't eligible. They were convinced they weren't eligible, and then you helped them to strategically design where they were using their PPP. The fact that on PPP2 they could use 40% of that money towards rent, utilities, even software potentially, and that freed up the cash for them to realize some significant money back.
Correct. Yes, I mean that's a great example. It's at this point, a lot of the value is preserving the forgivenesses, and then the second level is strategizing, right? So I gave the example earlier. $100,000 moved one way or the other is $70,000 in cash, and that could be just a week for some organizations. It could be a month, but it's all about balancing all of that out.
Yeah, just by utilizing their PPP, pushing it immediately out into the second quarter, we were able to automatically qualify them for the first quarter. That's $70,000 to them with only 10 employees. So such a huge big deal. I can tell you it's almost life-changing money, but certainly a lifeline for those people. So, strategically thinking about where you're utilizing this money is really important.
Agreed.
And then I will ask this one. I think this is probably pretty technical, and you're going to tell me we need to have a separate conversation.
There's one more on there, Dave.
Yeah, that's the one.
The IRS.
Yeah, that's the one I'm going to ask. How does IRS aggregation rules impact eligibility if we have several affiliated companies with common ownership? Example, affiliate A has down revenue in excess of 50%, but affiliate B has up revenue of 10%. Can affiliate A apply for ERC by itself, or do A and B have to aggregate gross receipts to determine if we meet the down revenue threshold?
Very technical, but not a common answer. So if you have common ownership, you need to aggregate all revenue and employees. So the 100 and 500 thresholds, you need to aggregate, and you need to fall under those thresholds. The disruption will apply. Think of a hotel group. Half your hotels are in Florida, half in Mass. Different rules, right? So Massachusetts, heavy restriction, Florida, wide open. The disruption in Mass, 10% or more, whole group qualifies, okay? Provided, again, you're under that 100 and 500 thresholds. In revenue, same thing. So you mentioned, I believe I heard 50 and 10, 10 up, 50 down.
Yeah.
I think the aggregate of that will probably get you to 20. I just don't know, you have to apply the dollars, right? So yes, combined. You need to treat them as, said differently, treat them as one taxpayer, roll everything up.
Okay.
The calculation gets done individually. So the calculation goes by the 941 or the EIN.
Excellent. Well, that looks like all of our questions today. Ryan, I can't thank you enough for being our guest. Hopefully everyone on the webinar found this to be helpful. I think it's huge opportunities for small businesses to get these lifelines and taking advantage. And they're so complicated and so nuanced and changing every day that a lot of people have missed them. So, don't take no as your first answer. Push back, look for opportunities, and we're pleased to be able to bring this. Ryan, any last comments from you?
No, I think Dave, you summarized it very well. Seek out the opportunities. It's always better to look thoroughly and firmly know that you don't qualify versus assuming that you don't qualify. So happy to have a conversation. Feel free to reach out to anybody on this call, and we can point you in the right direction.
Excellent. Thanks, everyone, and we hope to see you on future webinars as we continue to try to bring great value for small business owners. Thanks.
Everyone, bye.